Before we begin, it's important to understand that this presentation is for informational and educational purposes only. The information provided in this video is not financial, investment, or career advice. All career decisions involve risk and require careful consideration of your personal circumstances. The experiences and outcomes discussed are not guaranteed for everyone. You should always conduct your own thorough research and consult with qualified professionals before making any significant career or financial decisions. The average first-year analyst at a top investment bank in the United States now clears over $175,000. Let me say that again. 175. That's more than a lawyer fresh out of law school, more than a doctor in their third year of residency. It's a staggering number, and it's the reason why hundreds of thousands of the brightest, most ambitious students across the country compete for just a few thousand of these spots every single year. They fight tooth and nail for a chance to get in, but for most of them it feels like trying to break into a fortress. You know the feeling. You're smart, you're driven, you get good grades. You've probably spent countless nights grinding in the library. But when you look at Wall Street, you see a world of Ivy League degrees, of legacy connections, of people whose parents were partners at the firm. It feels like an exclusive club, and you weren't born with a membership card. You send out hundreds of applications into a black hole, you try to network on LinkedIn and get ghosted, and you start to wonder, is this even possible for someone like me? Is there a secret handshake I don't know? I'm here to tell you there is no secret handshake. But there is a blueprint. There is a proven step-by-step process that can take you from a complete outsider to a top candidate receiving multiple offers from the world's most elite financial institutions. And over the next 10 parts, I am going to give you that exact blueprint. This isn't going to be vague, motivational fluff. This is the definitive, no-nonsense masterclass on how to build a career in high finance in the United States. We are going to cover everything. We're going to break down the exact roles from investment banking and sales and trading to asset management and private equity, so you know precisely what they do and which path is right for you. We're going to build your resume from the ground up, line by line, transforming it from a standard college resume into a document that screams, "Hire me." We'll master the art of networking. Not the awkward, transactional kind, but the genuine relationship building that gets your resume on the top of the pile. We will dive deep into the technical questions, from accounting fundamentals and valuation methodologies to the brain teasers that are designed to break you. And we will conquer the behavioral interviews, crafting your personal story into a compelling narrative that convinces them you have the grit, the intelligence, and the hunger to succeed. By the end of this series, you will have a complete strategic plan. You will know what to do, when to do it, and how to execute with precision. The goal is not just to get you an interview, it's to get you the offer. But first, we have to shatter the biggest myth that holds people back. The myth that you have to go to Harvard, Wharton, or Stanford to even have a chance. Is it easier if you go to a target school? Absolutely. The banks are right there on campus holding events and actively recruiting. But does it mean it's impossible if you don't? Not even close. I have personally seen and worked with managing directors who went to state schools you've probably never heard of. The truth is, Wall Street is a meritocracy, but it's a very specific kind of meritocracy. They don't care where you started. They care about one thing and one thing only. Can you deliver overwhelming value? Can you outwork, outthink, and outhustle the competition? If your answer is yes, then your school's name on your diploma becomes a footnote, not a headline. Your path will be harder. You will have to be more strategic, more relentless in your networking, and more prepared than your Ivy League counterparts. But it is 100% possible. This blueprint is designed for everyone. Whether you're at a top-tier target school or a state university fighting for recognition, the principles are the same. The game is the same. You just have to learn the rules. So, let's start with rule number 1. Understand the landscape. You can't win a game if you don't know what you're playing. The term finance is huge and vague. People throw it around to mean a dozen different things. For our purposes, we're focusing on what's known as high finance, the most competitive, most lucrative, and most demanding sectors of the industry. Think of it as an ecosystem with different predators, each with a unique way of hunting. At the very center, you have the investment banking division, or IBD. These are the advisors. When a massive company like Apple wants to buy a smaller tech startup, or when a company like Uber wants to go public and sell its shares on the stock market for the first time, they call the investment bankers. Bankers are the ultimate deal makers. They build complex financial models to figure out what a company is worth. They create marketing materials and pitch books to persuade investors, and they navigate the intricate process of mergers, acquisitions, and IPOs. The lifestyle is brutal, we're talking 100-hour weeks, but the skill set you develop is unparalleled, and it's seen as the classic gateway to the rest of Wall Street. Then you have sales and trading, or S&T. If IBD are the advisors who structure the deals, S&T are the agents who execute in the live markets. They sit on a massive trading floor, surrounded by a dozen screens buying and selling stocks, bonds, currencies, and commodities on behalf of the firm and its clients. It's a fast-paced, high-pressure environment where you can make or lose millions of dollars in a matter of seconds. A trader's job is to manage risk and capitalize on market movements. A salesperson's job is to build relationships with huge institutional clients, like hedge funds and pension funds, and provide them with market insights and trading ideas. The personality type is often different here. It's less about long-term projects and more about quick, data-driven decisions under fire. Next in the ecosystem is asset management. These are the investors. Firms like BlackRock or Fidelity manage trillions of dollars on behalf of individuals and institutions. Their job is to take that money and grow it over the long term. They conduct deep research on companies, economies, and industries to decide which stocks or bonds to buy and hold. It's a more analytical, research-intensive, and long-term oriented role compared to the deal-making frenzy of IBD or the rapid-fire pace of S&T. If you love the intellectual puzzle of figuring out what makes a business truly valuable, this could be your world. And that brings us to the so-called buy side, the holy grail for many in finance. This includes private equity and hedge funds. After a few years in investment banking, many analysts will try to make the jump to a private equity firm. These firms use large amounts of debt to buy entire companies, operate them for a few years to improve their performance, and then sell them for a profit. It's like being an investment banker and a CEO rolled into one. You're not just advising on deals, you're owning the companies and making the critical operational decisions. Hedge funds, on the other hand, are more like the special forces of the investing world. They use a wide range of complex strategies to generate high returns for their wealthy investors, often making big, concentrated bets in the public markets. These are some of the most sought-after and difficult jobs to land in the entire industry. Understanding these core pillars, investment banking, sales and trading, asset management, and the buy side, is the foundational first step. They are all interconnected, but the day-to-day job, the required skills, and the culture of each are vastly different. Your first task is not to just blindly apply to Goldman Sachs. It's to do a deep, honest self-assessment and figure out which of these worlds truly aligns with your personality, your interests, and your long-term ambitions. Because choosing the right target is half the battle. In the next part, we're going to break down how to do exactly that, and begin crafting the single most important document in your job search, your resume. Think of your resume not as a history of your life, but as a 30-second Super Bowl commercial for the most important product you'll ever sell. It's a marketing document, and its only job is to get you the interview. Nothing more, nothing less. And you need to understand that the person reading it, a busy analyst, an associate, or an HR screener, is not going to read it. They are going to scan it. The 6-second rule is famous for a reason. Imagine a stack of 200 resumes on a desk. The screener picks one up. Their eyes dart to the top, university name, GPA, then to the most recent work experience, then maybe a quick glance at skills. That's it. 6 seconds. In that time, your resume is either put into the yes pile or the no pile. There is no maybe pile in investment banking. So, how do we survive the 6-second test? We start with the single most important, non-negotiable rule of finance resumes. 1 page. I don't care if you're a dual-degree PhD who interned at the White House and climbed Mount Everest. 1 page. Why? Because it proves you can synthesize vast amounts of information and present only what's most critical. That is literally the job of a junior banker. Your resume is your first test. A 2-page resume screams, I don't understand the rules and I can't prioritize information. It's an instant fail. Now let's build this 1-page weapon from top to bottom. It's built on 4 pillars. Pillar 1, the header. This sounds simple, but people get it wrong. Your name in a slightly larger font, centered or left aligned. Below that, your physical address, city and state is fine, your phone number, and your professional email address. And I mean professional. If your email is still skaterboy99@aol.com, go create a new one right now. firstname.lastname@email.com. That's it. Finally, include your LinkedIn profile URL. Make sure it's a customized URL, not the default one with a bunch of random numbers. It shows attention to detail. Pillar 2, Education. For a student or recent graduate, this is the most important section. It goes right at the top under your header. Lead with the official name of your university. Then, on the next line, your degree and major. For example, Bachelor of Science in Finance or Bachelor of Arts in Economics, minor in Mathematics. To the right of that, list your graduation date. And then the big one, your GPA. Let's talk about GPA. If your cumulative GPA is a 3.5 or higher, put it on. If it's below a 3.5, you have a choice. If your major-specific GPA is significantly higher, you can list that instead, clearly labeled as Major GPA. If both are below a 3.5, you might consider leaving it off entirely. It's not ideal, but it's better than advertising a low number. The resume's job is to get you past the screen. You can explain your academic journey in an interview. Also, list any academic honors, Dean's List, summa cum laude, and a few lines of relevant coursework. Don't list Intro to Sociology. List Advanced Corporate Valuation, Econometrics, Derivatives, Financial Accounting. This shows you've already started learning the language. Pillar 3, Professional Experience. This is the heart of your resume. This is where you prove you can do the work. You'll list your experiences in reverse chronological order. Most recent first. For each role, you list the company name, your title, and the dates you worked there. But the magic is in the bullet points below. Every single bullet point must be a powerful, action-oriented statement that showcases impact. We're going to banish weak, passive phrases forever. No more responsible for, or helped with, or tasked with. Instead, every bullet point will start with a strong action verb and end with a quantified result. Here's the formula. Action verb plus what you did plus the quantified impact. Let's see it in action. A typical, weak bullet point might say, responsible for building financial models for clients. That tells me nothing. It's boring. It's passive. Gets you in the no pile. Now let's transform it using our formula. Developed a discounted cash flow (DCF) model for a $200 million technology company, projecting 5 years of revenue growth to inform valuation. See the difference? We used the action verb developed. We specified what we did, a DCF model for a specific company size and sector, and we showed the impact it was used to inform valuation. Let's do another. Before, help the team with market research. After, analyzed market trends in the renewable energy sector by compiling data from 15+ industry reports, creating a 25-page presentation that was used by senior leadership to identify 3 potential acquisition targets. Quantify everything. How many reports did you analyze? How big was the deal? By what percentage did you increase efficiency? How much money did you save? Use numbers. Numbers are the language of finance. They cut through the noise and show concrete results. Even if your experience isn't directly in finance, let's say you worked as a waiter, you can apply this. Before, served customers in a busy restaurant. After, managed 15+ tables per shift in a high-volume restaurant, generating over $2,000 in nightly sales and contributing to a 10% increase in positive customer reviews. That shows you can handle pressure, you're results-oriented, and you understand the bottom line. That's a future banker. Pillar 4. Leadership, Skills, and Interests. This section, usually at the bottom, is where you add color and prove you're a well-rounded human being, not just a spreadsheet machine. Under leadership experience or extracurricular activities, list any clubs, sports, or volunteer work where you held a position of responsibility. Treasurer of the investment club, captain of the soccer team. These show teamwork, commitment, and leadership. Apply the same action verb and quantified result formula to these bullet points. Next is the skills section. This is a quick hit list. Be specific. Under technical skills, list things like Microsoft Excel, be prepared for a test on this, PowerPoint, and any financial platforms you know like Bloomberg Terminal, FactSet, or Capital IQ. If you have programming skills like Python or SQL, absolutely list them. Under languages, list any you speak fluently. Finally, the interest line. This is the most underrated part of the resume. Do not just write movies, sports, reading. It's a wasted opportunity. This is your chance to spark a real conversation in an interview. Be specific and unique. Instead of sports, write marathon runner, completed NYC Marathon 2023. Instead of reading, write reading presidential biographies or studying Japanese history. An interesting hobby makes you memorable. It gives the interviewer something to connect with you on a human level. Quick word on formatting. Keep it clean, professional, and brutally simple. Use a standard, readable font like Times New Roman, Garamond, or Calibri. Font size should be between 10 and 12 points. Use bolding and italics sparingly to guide the reader's eye. Margins should be normal, around 0.5 to 1 inch. The entire document should look balanced and uncluttered. Your goal is to make it as easy as possible for that 6-second scan. And my final, most critical piece of advice: proofread until your eyes bleed. Then have 2 friends proofread it. Then have your school's career center proofread it. A single typo or grammatical error signals a lack of attention to detail, which is a cardinal sin in finance. One mistake can and will get your resume thrown straight into the trash. When you save it as a PDF. Always. And name the file professionally. First name last name Zoom.pdf. This resume is your key. It's the document that unlocks the door to the first interview. But here's the secret that most people don't get. A perfect resume is useless if no one ever sees it. Submitting your application through an online portal is like buying a lottery ticket. The real way to get your resume on top of the pile is to get it into the hands of someone on the inside. And that requires mastering the art of networking. And networking is probably one of the most misunderstood, most dreaded words in the entire career lexicon. It conjures up images of stuffy rooms, forced smiles, and awkwardly trying to sell yourself to a stranger over a lukewarm appetizer. But that's not networking. That's a bad cocktail party. Real networking, the kind that gets you a 6-figure job at Goldman Sachs or Morgan Stanley, is something entirely different. It's not about schmoozing. It's about strategy. Forget the idea of asking for a job. Erase it from your mind. The moment you ask a stranger for a job, you become a liability. You're just another task on their to-do list. Instead, you need to reframe the entire mission. Your goal is not to get a job. Your goal is to get information. You're a detective, a journalist, an intelligence operative. Your mission is to learn. You are conducting what is known in the industry as an informational interview. That's the key that unlocks everything. Think about it from their perspective. An analyst at JP Morgan is working 90 hours a week. They get hundreds of emails from random students. 99% of them say some version of, "Hi, I'm a student, I want a job, can you help me?" Delete. It's transactional, it's lazy, and it offers them nothing. But one email is different. It says, "Hi, I saw you also graduated from State University and made the move to New York. I'm incredibly interested in the path you took, specifically your transition into the tech M&A group. If you have 15 minutes in the coming weeks, I'd be grateful for the chance to hear your story and get your advice." See the difference? You're not asking for a favor. You're showing admiration. You're asking for their story, their advice. You're appealing to their ego, and you're making it easy for them. You did your research. You made a personal connection. And you gave a specific low-commitment time frame, 15 minutes. Who doesn't have 15 minutes to talk about themselves and give advice to an ambitious younger version of themselves? This is how you get a response. So let's build the machine. Step 1. Create your target list. This is your battle plan. Open up a spreadsheet. Column name. Column B firm. Column C title. Column D school/alumni connection. Column E date contacted. You are going to build a list of 50 to 100 people. 100 sounds like a lot, but this is war. You don't go into battle with just one bullet. Where do you find these people? LinkedIn is your primary weapon. Go to the alumni page for your university. Filter by company. Goldman Sachs, Evercore, Lazard, Centerview. You now have a list of people who have a built-in subconscious reason to like you. They walked the same campus, they sat in the same lecture halls. This is your warm list. These are your highest priority targets. Then expand your search. Look for people from your hometown. People who were in the same fraternity or sorority. People who played the same sport. Any point of connection, no matter how small, is a lever you can use to open the door. You're looking for a hook. The goal is to turn a cold email into a lukewarm one. Step 2. The email. We already touched on this, but let's perfect it. Your subject line is critical. It needs to be clear and concise. Student from your university seeking advice, or quick question from a fellow university mascot. It's honest and it won't get flagged as spam. The body of the email needs to hit 4 points fast. 1. A brief, one-sentence introduction of who you are. My name is Jane Doe, and I'm a sophomore finance major at State University. 2. The connection. Show you did your homework. I came across your profile on LinkedIn and was incredibly impressed by your path from our alma mater to your current role in leveraged finance. 3. The ask. This is the informational interview request. I am trying to learn as much as possible about the industry, and your perspective would be invaluable. Would you be open to a brief 15-minute phone call in the next couple of weeks to share some of your experiences? For the logistics, make it effortless for them. I am free anytime that is convenient for you. Please let me know what works best. That's it. It's short, respectful, specific, and easy. You will not get a 100% response rate. You might get a 20% or 30% response rate if you're good. That's why you have a list of 100 people. This is a numbers game. You need to be relentless and systematic. Send out 5 to 10 of these emails every single day. Track it in your spreadsheet. If you don't hear back in a week, send a polite one-sentence follow-up. Step 3. The call itself. They said yes. Now what? Do not waste their time. You have a 15 to 20-minute window to make an impression. Your goal here is threefold. Build rapport, learn as much as you can, and get them to like you. Your first priority is to get them talking about themselves. People love talking about themselves. Don't start with, "So, what's it like working at Goldman?" That's a boring question they've answered 1,000 times. Start with their story. I'd love to just start by hearing a bit about your journey. What first got you interested in finance back at school? And how did you navigate your way to your current desk? Let them talk. Listen. Be genuinely curious. Have a list of smart, prepared questions, but don't just read them off a script. Let the conversation flow naturally. Ask about their specific deals. Ask about the culture of their group versus the rest of the firm. Ask what surprised them most when they first started. Ask what a typical day really looks like, not the polished version from the company website. Ask what skills they think are most critical for a junior analyst to succeed in their first year. You are gathering intelligence. You are learning the language, the culture, the pain points. And through this process, they are getting to know you. They're seeing that you're smart, you're hungry, and you're professional. You are not, under any circumstances, to ask for a job or an internship. If they like you, they will often offer to help on their own. As the call is winding down, you ask the single most important question of the entire conversation. Based on our conversation, is there anyone else you think it would be helpful for me to speak with? This is the golden question. This is how you turn one contact into 3. A warm referral from a colleague is 1,000 times more powerful than a cold email. Now you're not just a random student. You're the student that Sarah told me to talk to. You are building a web of contacts inside the firm. Step 4. The follow-up. Within 24 hours of the call, send a thank you email. Not a generic one. Reference something specific you talked about. Thank you again for your time today. I found your advice about preparing for the technical questions particularly helpful, and I really enjoyed hearing the story about the specific deal you worked on. It shows you were listening, and then you play the long game. This isn't a one-time transaction. You're building a relationship. Every 2 or 3 months, send a brief update. Hi John, hope you're doing well. Just wanted to send a quick update. I took your advice and joined the investment club on campus, and we just finished a stock pitch on Tesla. I also wanted to thank you again for connecting me with Sarah in your group. We had a great conversation last week. You are staying on their radar, demonstrating progress, and showing that you value their advice. You do this over and over again. With dozens of people. Across all of your target firms, you become a known quantity. You're no longer just a name on a resume in a black hole of an online portal. You are the student who's been talking to analysts and associates for the past 6 months. You have internal champions. You have people who know your name, who like you, and who will now walk your resume down the hall and place it directly on the hiring manager's desk. They will vouch for you. They will say, hey, you should talk to this kid. They're sharp. This is the hidden path. This is the system that students from non-target schools use to beat out kids from Harvard and Wharton. It is a staggering amount of work. It requires discipline, organization, and a thick skin. But it bypasses the entire system of automated resume screens and luck. You are no longer hoping to win the lottery. You are systematically engineering your own luck, conversation by conversation, email by email. All of this work, all these conversations, they all lead to one place, the interview room. And that's where the real trial by fire begins. The door closes behind you, and the sound echoes in a room that suddenly feels a lot smaller. The air is thick with expectation. Across the table sit two people who hold your future in their hands. They've seen hundreds of candidates just like you. Same suit, same polished resume, same nervous energy. They are trained to see through the facade in seconds. What they're looking for isn't just a set of skills. They're looking for a specific type of person. And in the next 30 minutes, you have to prove you are that person. This is the investment banking interview, and it's a two-headed beast. On one side, you have the fit interview. On the other, the technical interview. You cannot tame one without the other. Excelling at the technicals while failing the fit makes you a brilliant jerk nobody wants to work with. Acing the fit but bombing the technicals makes you a friendly liability. You must conquer both. Let's start with the fit interview because it's the one people underestimate the most. They think it's just a casual chat. It's not. It's a meticulously designed psychological evaluation disguised as a conversation. The core question they are trying to answer is simple. Do I want to be stuck in an airport with this person for 8 hours during a delayed flight after a deal just blew up? It's called the airport test and it's deadly serious. To pass it, you need to be more than just likable. You need to radiate a quiet confidence, an intense curiosity, and an almost obsessive work ethic. Every answer you give must be a story, and every story must have a point that reinforces why you belong there. The first question is almost always the same. Walk me through your resume. This is not an invitation to read your resume out loud. It is your opening monologue. It's your chance to frame your entire narrative. The best way to structure this is the past, present, future model. Your past is a quick summary of where you came from, leading up to your key experiences. I grew up in X, went to Y University where I majored in Z. Early on, I was fascinated by. Keep it concise. Your present is the core of your story. This is where you connect the dots on your resume. Don't just list your internships. Explain the why. My internship at the boutique firm exposed me to live deal flow and taught me the importance of attention to detail, while my experience leading the investment club showed me I could manage a team under pressure. These experiences solidified my desire to work on larger, more complex transactions. Your future brings it all home. This is where you explicitly state your goal. And that's why I'm here today. I want to leverage my analytical skills and my drive to contribute to a team like yours, specifically within the technology group, because I'm incredibly passionate about the SaaS space. In 2 minutes, you've told them who you are, what you've done, and why you're sitting in that chair. You've taken control of the narrative. Next comes, why this firm? This is where 90% of candidates fail. They give a generic, flattering answer they found on the Companies About Us page. Well, Goldman Sachs is a global leader with a prestigious reputation and a collaborative culture. That answer is worthless. It shows you've done zero real work. Your answer must be specific. It needs to prove you've done the hard research. Talk about a specific deal they recently closed. I was fascinated by your team's advisory role on the Salesforce acquisition of Slack. The valuation complexity given the all-stock nature of the deal was something I studied closely, and it's the kind of challenge I want to work on. Mention a specific person you spoke to. Actually, I had a great conversation with Jane Doe from your industrials group, and the way she described the team's lean structure and the level of junior banker responsibility was exactly what I'm looking for. Specificity is your greatest weapon. It shows genuine interest, not just a desire for any job. Finally, you'll get the behavioral questions. Tell me about a time you failed. Tell me about a time you worked on a team. Tell me about a time you had to persuade someone. For every one of these, you must use the STAR method. Situation, task, action, result. Situation, set the scene. In my corporate finance class, we were assigned a group valuation project for a major company. Task. What was the goal? My task was to build the discounted cash flow model, but one of our team members was consistently missing deadlines and submitting subpar work, jeopardizing the entire team's grade. Action. What did you do? Don't say we. Say I. I scheduled a one-on-one meeting with the team member to understand the issue. It turned out they were struggling with the concepts. I spent 2 evenings tutoring them on the mechanics of the model and redistributed some of the workload to play to everyone's strengths. Result. Quantify it. As a result, the team member became a motivated contributor, our final model was incredibly robust, and we received an A on the project. More importantly, I learned that leadership isn't about calling people out.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
It's about understanding their challenges and enabling them to succeed. The STAR method forces you into a narrative structure that demonstrates problem-solving skills and maturity. It turns a simple question into a compelling story about your character. Master this and you've mastered the FIT interview. But a great personality will only get you so far. Then comes the second head of the beast, the technical gauntlet. This is where they stress test your brain. The pace is rapid fire. The questions are designed to be tricky. They want to see how you think under immense pressure. Making a small math error is forgivable. Not knowing a fundamental concept is an instant disqualification. The technical questions fall into three main buckets: accounting, valuation, and M&A/LBO theory. Accounting is the language of business. If you're not fluent, you can't work in finance. Period. You must know the three financial statements, the income statement, the balance sheet, and the cash flow statement inside and out. More importantly, you must know how they link together. A classic question is, assume depreciation, a non-cash expense, goes up by $10. Walk me through the impact on the three financial statements. Here's how you answer calmly and logically. Okay, starting with the income statement. An increase of $10 in depreciation will reduce your pre-tax income by $10. Assuming a 20% tax rate, your net income will decrease by $8. Moving to the cash flow statement. You start with that net income, which is down by $8. But you have to add back the $10 of depreciation because it's a non-cash expense. So, your cash flow from operations actually increases by $2. Finally, on the balance sheet. On the asset side, cash is up by $2 from the cash flow statement. But property, plant, and equipment is down by $10 due to the increased depreciation. So the asset side of the balance sheet is down by a net of $8. On the liabilities and equity side, retained earnings is down by $8 because net income fell by $8. So both sides of the balance sheet are down by $8, and it remains in balance. That is a perfect answer. It's structured, it's logical, and it proves you understand the fundamental mechanics of finance. The second bucket is valuation. This is the art and science of determining what a company is worth. You need to know the main methodologies called discounted cash flow, or DCF, which is valuing a company based on the present value of its future cash flows. Comparable company analysis, or comps, which is valuing a company based on what similar public companies are worth. And precedent transactions, which is valuing a company based on what similar companies have been acquired for in the past. You'll be asked about the pros and cons of each, and when you might use one over another. The third bucket is M&A and leveraged buyout, or LBO concepts. How does an M&A deal create or destroy value? What is accretion/dilution? What makes a good LBO candidate? These questions test your commercial acumen. They want to know if you can think like an investor, not just a student. They might also throw in brain teasers like, how many ping pong balls can you fit in a 747? The answer doesn't matter. Your process does. They want to hear you think out loud. Okay, first I'd need to estimate the internal volume of a 747. Then I'd estimate the volume of a single ping pong ball. I'd have to account for the fact that spheres don't pack perfectly, so there would be wasted space. It's a test of your ability to break down an ambiguous problem into logical, manageable steps. The interview is a performance. The FIT portion tests your emotional intelligence and your story. The technical portion tests your intellectual horsepower and your preparation. You need to deliver a flawless performance on both stages. Because if you do, if you can prove that you are the smart, hungry, and remarkably resilient person they're looking for, you'll get the call. You've survived the first round. But this was just the qualifier. Now you're invited to the main event. A final grueling marathon of interviews designed to push you to your absolute limit. They call it the Super Day. The Super Day. The name itself is designed to sound intimidating, like the final boss battle in a video game you've spent months preparing for. And in many ways it is. This isn't just another interview. It's a high-stakes, high-pressure audition. A single day that can define the entire trajectory of your early career. You get the email, usually a week or two in advance. They're flying you out. New York City. The big league. They book your flight. They book your hotel near the office in Midtown or the financial district. For a moment you feel like a star. But that feeling is quickly replaced by a wave of pure, unadulterated terror. because you know what's coming. A super day is not a single hour-long conversation. It's a marathon of interviews, typically lasting anywhere from 4 to 8 hours. You'll be ushered into a conference room with a dozen other top candidates from across the country, your direct competition. Then, one by one, you'll be pulled into offices for a series of back-to-back 30 to 45-minute interviews with a whole hierarchy of bankers. You might start with an analyst, then an associate, a vice president, and if you're doing well, you could end up in front of a managing director. Each interview is a new test, a new judge, a new chance to prove yourself or to fail spectacularly. There are no breaks. There is no time to reset. It is a relentless intellectual and social gauntlet. The test often begins the night before, at the pre-interview dinner. Don't be fooled by the casual atmosphere. This is not a friendly welcome. This is the first and perhaps most critical filter, the airport test. The bankers who take you out are asking themselves a simple question. Could I stand being stuck in an airport with this person for 8 hours during a delayed flight? They're evaluating your social skills, your personality, your ability to hold a conversation. Are you awkward, arrogant, boring, or are you engaging, curious, and genuinely personable? Order a steak, not messy spaghetti. Have one drink, maybe two if you're a slow sipper, but absolutely no more. Ask them intelligent questions about their work and their lives outside the bank. This is your chance to show them you're not just a spreadsheet robot. You're a human being they could tolerate working with for 100 hours a week. Pass this and you've cleared the first hurdle. Fail it, and your super day might be over before it even begins. The next morning, you arrive at their towering glass skyscraper, and the real games begin. The interviews you'll face can be broken down into 3 core pillars. You must be an absolute master of all 3. The first pillar is the technicals. This is the foundation. If you are weak here, you will be exposed and you will be sent home. This is where they test your raw financial knowledge. They need to know that you have the intellectual horsepower to do the work. You will be asked to walk them through the 3 financial statements: the income statement, the balance sheet, and the cash flow statement. But they won't stop there. The classic follow-up is, how do they link together? You need to be able to explain flawlessly how net income from the income statement flows to the top of the cash flow statement and also into retained earnings on the balance sheet. You need to explain how changes in working capital on the balance sheet affect cash flow. They will drill you on this until they are satisfied you understand it in your bones. Then comes valuation. How do you value a company? Is the single most common technical question. You must describe the main valuation methodologies. Discounted cash flow analysis, or DCF, where you project a company's future cash flows and discount them back to the present. You'll need to know how to calculate weighted average cost of capital, or WACC. They'll ask about comparable company analysis, or comps, where you value a company based on the multiples of similar publicly traded companies. And they'll ask about precedent transaction analysis, valuing a company based on what similar companies have been acquired for in the past. They'll ask for the pros and cons of each. They might give you a hypothetical scenario. If you could only have 2 of the 3 financial statements to value a company, which 2 would you choose and why? The answer, by the way, is the income statement and the balance sheet, because from those 2 you can build the cash flow statement yourself. These questions aren't meant to be obscure trivia. They are a direct test of your ability to think like a banker and handle the core components of the job. The second pillar is the behavioral. This is where they figure out who you are. The technical questions test your brain. The behavioral questions test your character, your drive, and your story. You will be hit with the classics. Walk me through your resume. This is not a request to read your resume aloud. It is an invitation to tell your story. You need a polished 2-minute narrative that connects the dots of your life, your background, your college choice, your major, your internships, and leads directly and inevitably to this moment, sitting in this chair, wanting to work in investment banking at this specific firm. Then comes, why investment banking? A bad answer is, I want to make a lot of money. A good answer talks about a passion for working in a fast-paced, challenging environment, a desire to advise companies on their most critical strategic decisions, and the opportunity for an unparalleled learning experience. And then the most important one, why our firm? This is where your research is critical. You cannot give a generic answer. You must name specific deals they've recently advised on. You must mention a specific industry group they're strong in that aligns with your interests. You might even mention an analyst you spoke with during your networking calls and something insightful they told you. You have to prove that you don't just want a job in banking, you want this job at this bank. They will also test your resilience with questions like, tell me about your biggest failure, or tell me about a time you worked on a team and faced a conflict. They're not looking for perfection. They're looking for self-awareness, humility, and proof that you can learn from your mistakes and handle pressure. The third and final pillar is the markets and deals. This is what separates the top candidates from the rest of the pack. They want to see if you have a genuine burning passion for the markets. They'll ask, what's the S&P 500 at today? Or, where is the 10-year Treasury yield? You should know these numbers cold. They'll ask you to pitch them a stock, one long and one short. You need to come prepared with a well-researched thesis for why you think a particular company is over or undervalued. But the real test is the deal discussion. They'll say, tell me about a recent M&A deal you found interesting. You need to be able to talk intelligently about a recent transaction, who bought whom for how much, the strategic rationale behind the deal, and whether you think it was a good or bad move. This demonstrates that you're not just a student who memorized a textbook. You're an active, engaged participant in the financial world. It shows them that you do this because you love it, not just because you want a job. Throughout this entire process, they are evaluating your energy, your enthusiasm, and your composure. By the fifth or sixth interview, you will be mentally drained. But you cannot let it show. You have to walk into that last interview with the same energy and focus as you had for the first. They're stress testing you. They want to see who cracks and who rises to the occasion. Remember, they are picturing you at 2 a.m., 6 months into the job, sleep-deprived and stressed, trying to finalize a pitch book for a client. Will you be the person who complains and melts down, or the one who stays positive, focuses, and gets the job done? The super day is their best simulation of that environment. You walk from office to office, shaking hands, answering the same questions with fresh energy each time, trying to build a connection with each person in just 30 minutes. You solve their math problems on the whiteboard, you defend your stock pitch, you tell your story again and again. It's an exhausting performance. And then just like that, it's over. A recruiter thanks you for coming and walks you to the elevator. You step out of the climate-controlled silence of the bank and back into the chaos of the New York City streets. Your mind a complete blur. You've just run a mental marathon. You've given every ounce of preparation and energy you had. And now there is absolutely nothing left to do. Nothing but go to the airport, fly home, and wait. You wait for the phone call that will determine whether it was all worth it. The call that will change your life one way or another. That wait is a unique form of torture. It's a silent, internal screaming match between hope and despair. Every time your phone buzzes, your heart leaps into your throat, only to crash when you see it's a text from your mom or a notification from a food delivery app. You start to develop a phantom buzz, feeling your phone vibrate in your pocket when it's perfectly still. You replay every single answer you gave. That question about valuation methodologies. Did I explain DCF clearly enough? Was my answer on the 3 financial statements too textbook? Did I sound confident? Or did I sound arrogant? That managing director who seemed disengaged, was he just tired, or did I completely bomb that interview? You dissect every handshake, every smile, every single micro-expression you can remember. It's an endless loop of self-doubt, a highlight reel of your perceived failures. You tell yourself you won't check your email again for at least an hour. 30 seconds later, you're refreshing your inbox, your thumb swiping down with a frantic, desperate energy. You go online to forums like Wall Street Oasis, searching for threads about your specific bank's super day. You see posts from other anonymous candidates. Just got the call from Goldman Sachs TMT. Your stomach drops. Anyone hear from Morgan Stanley M&A yet? The silence in the thread is deafening. You're in a digital waiting room with 100 other people who are just as terrified as you are. It's a shared purgatory, and then it happens. Usually when you least expect it. Maybe you're grabbing a glass of water, or you've finally given up and put on a movie to distract yourself. An unknown number from a 212 area code flashes on your screen. New York City. Time slows down. The air gets thick. You can hear your own heartbeat in your ears. A frantic drum solo against the silence of your room. This is it. This is the moment. Your hand is shaking as you swipe to answer. You try to clear your throat and sound calm, professional, like this call is just another Tuesday. Hello, this is. The voice on the other end is cheerful. It's one of the bankers you met, maybe the VP who grilled you on LBOs. They make a little small talk. Hey, how's it going? Great to meet you last week. It's agonizing. You just want them to get to the point. And then they do. Well, the team and I were all incredibly impressed with you during the interviews. And so on behalf of the firm, I'd like to formally extend you an offer to join our investment banking summer analyst class. The words hit you like a physical force. It's not just relief. It's a tidal wave of validation. Every late night in the library, every networking email that went unanswered, every practice interview, every moment of soul-crushing doubt, it all collapses into this one single perfect moment. A flood of dopamine rewrites your brain chemistry. You probably say something coherent like, "Thank you so much, I'm so excited." But on the inside, you're screaming. You've done it. You've actually done it. You got the offer. The rest of the call is a blur. They'll talk about official offer letters, HR paperwork, and next steps, but you're not really listening. You're floating. After you hang up, you just sit there for a minute letting it sink in. You look around your quiet dorm room or your messy apartment, and it feels different. The whole world feels different. You've just punched your ticket to a new life. Then you make the second most important call of the day, the one to your parents. Hearing the pride and joy in their voices, that's a feeling you'll never forget. You celebrate. You go out with your friends. For one night, you are on top of the world. You've won the game. But here's the secret no one tells you about that moment. Getting the offer isn't the finish line. It's the starting line of a completely different race. One that's infinitely more demanding than the one you just ran. The entire recruiting process, from the first coffee chat to the final super day, was a sales process. You were selling yourself, and the bank was selling you a dream. They sold you on the prestige, the deal-making, the high-stakes environment, the unparalleled learning experience. Now the sale is over, and you're about to discover what you actually bought. What does a first-year investment banking analyst actually do? Forget the images from movies of people yelling buy, 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 or making billion-dollar decisions in a slick boardroom. The reality for the first year, and honestly the first 2 years, is far less glamorous. You are, in the bluntest terms, at the absolute bottom of a very steep pyramid. Your job is to support everyone above you. The associates, the vice presidents, the directors, and the managing directors. You are the hands of the operation. Your brain is a tool to be used, but your primary function is to execute flawlessly and quickly. Your life will revolve around 3 core pieces of software: Microsoft Excel, Microsoft PowerPoint, and Microsoft Outlook. That's it. That's the holy trinity of a junior banker. Let's start with Excel. You will live inside of spreadsheets. You will become what's affectionately, or not so affectionately, known as an Excel monkey. You'll be building financial models from scratch, forecasting a company's performance years into the future. You'll be creating valuation analyses, like discounted cash flow models, or comparing public companies and precedent transactions to figure out what a business is worth. But a huge portion of your time will be spent on tasks that feel mind-numbingly tedious. You'll be spreading comps, which means manually pulling data from financial reports and inputting it into a spreadsheet to compare dozens of companies. You'll be cleaning up data, formatting cells to match the bank's specific style guide, colors, fonts, borders, with a level of precision that would make a drill sergeant proud. Every number has to be perfect. Every formula has to be correct. A single misplaced decimal point can be a firing offense, because that tiny error could cascade through a model and lead to a valuation that's off by millions or even billions of dollars. Next is PowerPoint. This is where the story is told. All that data you crunched in Excel gets translated into slides for a pitch deck. A pitch deck is a book, sometimes over 100 pages long, that the senior bankers use to persuade a client to hire them, or to recommend a certain action, like selling their company or acquiring another one. Your job as the analyst is to create these slides. You'll be making charts, graphs, and tables. You'll be writing text, summarizing market trends, and describing a company's business. And just like with Excel, the attention to detail is fanatical. Is the company logo on the bottom right of every single page? Are all the slide titles the exact same font size? Are the blue boxes in this chart the exact shade of blue in the bank's official color palette? You will spend hours, often late into the night, nudging a text box 1 pixel to the left, then 1 pixel back to the right until it is perfectly aligned. It will feel insane. It will feel like the least important work in the world. But to the bank, this presentation is their product. It's their brand, and perfection is the only acceptable standard. Finally, there's Outlook. Your inbox is your command center and your prison. It's a relentless stream of requests from your deal teams. Can you update the comps for Q3 numbers? Need a new draft of the deck by 9 a.m. Please print 10 copies of the presentation and have them bound for the morning meeting. This brings us to the third unglamorous pillar of your job: administrative work. You will be printing and binding pitch books. You'll be scheduling conference calls across different time zones. You'll be taking notes on those calls. You are the team's project manager, scribe, and production facility, all rolled into one. This might sound horrible, and at times it is. It's a grind, but there's a purpose to the madness. This process is the modern-day equivalent of a medieval apprenticeship. You're not just pushing pixels and numbers around. You are learning the business from the ground up, in the most granular detail imaginable. By manually inputting data, you learn what to look for in a financial statement. By building models, you learn the mechanics of how a business is valued. By creating pitch decks, you learn how to structure an argument and tell a compelling financial story. And by surviving the pressure and the insane hours, you are being forged into the kind of professional the bank needs you to be: resilient, meticulous, and incredibly fast. You got the offer. You celebrated. But now you have to learn how to do the job. You have to survive. And survival in this world is a completely different game. The first 60 seconds on the trading floor, or in the bullpen, feel like stepping into a different dimension. The low, constant hum of computers, the staccato rhythm of keyboards, the disembodied voices on speakerphones. It's an ecosystem with its own language and its own laws of physics. Time moves differently here. Your 9-to-5 life is a distant, quaint memory. The first casualty of your new career is your old life. You're handed a laptop, a security badge, and a phone with more lines than you know what to do with. The training program, a whirlwind of PowerPoints and compliance modules, is designed to feel like drinking from a fire hose. But it's a lie. The fire hose doesn't truly open until you get your first real assignment. It's midnight on a Tuesday. An associate walks over to your desk, drops a thick, red-lined binder on it and says, "The MD wants to see a new version of the model by morning, and we need to update the comps section of the deck. Let me know if you have any questions." He walks away. You have a million questions. But the first unspoken rule you learn is this: don't ask questions you can answer yourself. And the second rule: figure it out fast. You quickly realize that your Ivy League degree in finance taught you the elegant theory of the forest, but the job is about knowing every single leaf, every piece of bark on every single tree. This is the beginning of the analyst grind. Those infamous 100-hour workweeks you heard about? They aren't a myth. But they're also not 100 hours of high-stakes, Wolf of Wall Street deal-making. For an analyst, the job is far less glamorous. You become a master of two things: Microsoft Excel and Microsoft PowerPoint. These aren't just software. They are the battlegrounds where your career is forged. Let's break down what you're actually doing. Your primary function is to support the senior bankers, the associates, vice presidents, and managing directors, who are responsible for bringing in and executing deals. Your role is to be the engine room of that process. A huge part of your life revolves around building and maintaining financial models in Excel. You'll build a discounted cash flow, or DCF, model from scratch, projecting a company's financials 10 years into the future to determine its value. You'll build a leveraged buyout, or LBO model to see if a private equity firm can make a return on buying a company. You'll build merger models to analyze the impact of one company acquiring another. These aren't simple spreadsheets. They are sprawling, interconnected universes of data, where a single misplaced comma can throw off a valuation by millions of dollars. Your job is to make them perfect. Every formula, every cell, every assumption must be flawless and traceable. The other half of your universe is the pitch book. This is the PowerPoint deck that bankers use to pitch ideas to clients. It might be a pitch to convince a company to sell itself, or to buy another company, or to raise money. These decks can be over 100 pages long and are your responsibility to create and, more importantly, to edit. This is where you learn the true meaning of the phrase, turning comments. Your associate will give a draft of the deck to the vice president. The VP will print it out, mark it up with a red pen, changing words, asking for new charts, questioning data, and give it back to the associate. The associate then hands it to you, the analyst, to make every single change. You make the changes, you print it, and it goes back up the chain. Then the managing director sees it. He marks it up with his blue pen. More changes. The client's logo on page 73 is a pixel off-center. The font size in the footnote on page 48 is 7.5 instead of 8. The shade of blue in the chart on page 19 isn't the official corporate blue. This process can happen 5, 10, 20 times. At 2 in the morning. At 4 in the morning. Your world shrinks to a feedback loop of revisions. Feels maddening. Feels pointless. Why does this level of detail matter? Because in this world, detail is a proxy for trust. No managing director is going to put a 22-year-old in a room with a Fortune 500 CEO. They can't trust your judgment or your client-facing skills yet. But they must be able to trust, with absolute certainty, that the number in the bottom right corner of page 82 of the appendix is correct. They must know that when they are in that high-stakes meeting, the materials they present are bulletproof. Every perfectly aligned logo, every consistent font, every checked and rechecked number is a brick in the foundation of that trust. You're not just moving boxes around on a slide. You are demonstrating your reliability, your meticulousness, your ability to execute flawlessly under extreme pressure. This relentless pursuit of perfection is what the first 2 years are all about. It's a crucible designed to do two things. First, to teach you the fundamentals of the business at the most granular level possible. You learn how companies work, how deals are structured, and how to value a business not from a textbook, but by living inside the numbers day in and day out. You learn the language of finance not in a classroom but under fire. Second, it's a filter. The lifestyle is brutal. You'll miss birthdays, weddings, and holidays. Your social life will evaporate. You'll survive on takeout food eaten at your desk and a few hours of sleep. Many people can't handle it. They burn out. They quit. The bank knows this. The system is designed to weed out those who lack the stamina, the obsessive attention to detail, and the sheer force of will to survive. It's a 2-year-long stress test. But within this pressure cooker, a strange and powerful bond forms. The other analysts in your class, sitting alongside you in the bullpen at 3 in the morning, become your family. You share gallows humor. You cover for each other. You teach each other Excel shortcuts that feel like life-saving secrets. This shared experience creates a network that will last your entire career. You are all in the trenches together. And this camaraderie is often the only thing that gets you through the toughest nights. You learn the unspoken rules. You learn to manage upwards, to anticipate what your associate needs before they ask, to provide timelines for your work, to flag potential problems early. You learn that face time is real. You never leave the office before your direct superior does, even if you have nothing to do. You learn that your phone is an extension of your body. You must be reachable 24/7. A missed call from your VP at 10 p.m. on a Saturday is not an option. Sounds impossible, but you adapt. You become incredibly efficient. You learn to operate on minimal sleep. You master keyboard shortcuts until you can build a chart without ever touching the mouse. Your entire way of thinking changes. You become hyper-organized, ruthlessly logical, and almost pathologically detail-oriented. The person you are after 2 years in this environment is fundamentally different from the person who showed up on day one. The analyst program isn't a job. It's a metamorphosis. It's a trial by fire designed to strip you down and rebuild you into the kind of professional who can be trusted with deals worth billions of dollars. And as you approach the end of those 2 years, exhausted and transformed, a new set of questions emerges. You've proven you can survive the grind. You've paid your dues. Now what do you do with it? Where do you go from here? The path forward splits, and the choices you make at this juncture will define the entire trajectory of your career. The first fork in the road is the path of the lifer. This is the path of staying in investment banking. Now I know what you're thinking. After everything we've talked about, the brutal hours, the grind, the sacrifice, why would anyone choose to stay? Because for a certain type of person, the game itself is the reward. These are the people who don't just tolerate the deal-making process. They thrive on it. They love the thrill of the pitch, the adrenaline of a live M&A transaction, the satisfaction of seeing a deal they orchestrated on the front page of the Wall Street Journal. For them, moving to the buy side or into a corporate role feels like leaving the Super Bowl to go play in a minor league. They want to be in the center of the universe where the biggest deals are happening. This path is a climb up a very specific ladder, from associate to vice president or VP. As a VP, you're no longer just the person grinding out the models until 4 a.m. You're the project manager. You're the primary point of contact for the client. You're the one managing the associates and analysts beneath you, reviewing their work, and ensuring the trains run on time. The technical skills are still critical, but now a new skill set emerges: management and client relationship skills. The pressure shifts from "can you do the work?" to "can you lead the team that does the work?" From VP, the next step is director, and then the summit managing director or MD. This is the final evolution. As an MD, you are no longer primarily an executor of deals. You are an originator of deals. You are a salesperson. Your entire job, your multi-million-dollar bonus, is predicated on your ability to bring in business. You spend your days on planes, in boardrooms, and at steakhouses, cultivating relationships with CEOs and CFOs. You're not building the pitch book anymore. You are the pitch book.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Your reputation, your network, your ability to convince a Fortune 500 CEO to trust you with the most important transaction of their career. That is your value. The lifestyle doesn't get easier, it just changes. The physical grind of all-nighters is replaced by the immense mental pressure of a personal revenue target. But for those who make it, the rewards are astronomical. You are a titan of the industry, a true master of the universe. But for many, perhaps most, banking was never the destination. It was the vehicle. It was the best, most intense training program in the world for what they really wanted to do. And that leads us to the second and most coveted fork in the road: the leap to the buy side. The term buy side refers to firms that buy and invest in assets. Think private equity funds, hedge funds, and venture capital. This is the fundamental shift in your career. As an investment banker, you are on the sell side. You are an agent, a professional advisor. You're like a high-end real estate agent who helps people buy and sell multi-billion-dollar mansions. You facilitate the transaction, you provide expert advice, you collect a handsome commission, and then you move on to the next deal. You never actually own the house. On the buy side, you own the house. You are the investor. You are the principal. You're not just advising on the sale. You're putting your own, or your funds, capital at risk with the goal of generating a return. This is the key difference, and it changes everything. The work becomes more intellectually rigorous, more long-term, and for many, infinitely more satisfying. Within the buy side, the most well-trodden path for former bankers is private equity, or PE. If investment banking is like being a real estate agent, private equity is like being a professional house flipper. A PE fund raises a massive pool of capital from investors, and their job is to go out and buy entire companies. They don't just buy them to hold them. They buy them with a specific thesis on how they can improve the business, cut costs, expand into new markets, make strategic acquisitions, improve operations. They hold the company for 3 to 7 years, work intensively to increase its value, and then sell it for a significant profit. As a PE associate, your job is to find and analyze these potential investments. The modeling skills you learned in banking are now on steroids. You're not just modeling a sale, you're modeling an entire business's future under your ownership. You're conducting insane levels of due diligence, talking to industry experts, digging through every line of the financials to find hidden opportunities and risks. The hours are still brutal, often just as bad as in banking, but the nature of the work is different. It's proactive, not reactive. You are hunting for opportunities, not just responding to a client's request. And the ultimate prize in private equity is something called carried interest. This is the holy grail. It means you, personally, get a percentage of the profits the fund generates. You're no longer just earning a salary and a bonus. You are a part owner. You have a direct stake in the outcome of your investments, and this is how real generational wealth is created in finance. The other major buy-side path is to a hedge fund. If private equity is for the builder and the operator, hedge funds are for the thinker and the trader. A hedge fund is an investment pool that can invest in basically anything: public stocks, bonds, currencies, commodities. They use complex strategies to try and generate high returns regardless of whether the market is going up or down. As a hedge fund analyst, your life is the market. You are developing an investment thesis, a core belief about why a certain stock is undervalued or overvalued, and then you are defending that thesis with an incredible depth of research. You might spend 6 months becoming the world's foremost expert on a single semiconductor company before you recommend a position. The feedback loop is immediate and relentless. You know if you were right or wrong at the end of every single trading day. The pressure is immense, a constant intellectual battle against the entire market. It's a pure meritocracy. If you make the fund money, you are rewarded handsomely. If you lose money, you're out. It's a high-stakes, cerebral game for those who are obsessed with the puzzle of the global markets. Now there's a third path, a path that for a long time was seen as selling out, but is now viewed as a smart strategic move for a different kind of life. This is the path to corporate. This means leaving the world of pure finance, the client service world of banking, or the investment world of the buy side, and going to work for a regular company. Think Google, Apple, Nike, Procter & Gamble. But you're not just taking any job. You're leveraging your elite finance skill set to land a role in one of two key areas: corporate development or corporate strategy. The corporate development team is essentially an in-house M&A team. When a company like Microsoft wants to buy a smaller tech company, it's the corp dev team that sources the deal, does the analysis, and executes the transaction. As a former banker, you are now the client. You're sitting on the other side of the table, hiring the Goldman Sachs and JP Morgans of the world to advise you. You get to work on fascinating deals that shape the future of the company, but without the brutal, unpredictable lifestyle of a service provider. The corporate strategy team is a bit different. They are the internal think tank for the CEO and other top executives. They tackle the biggest, most complex questions the company faces. Should we enter the market in India? Should we launch a new product line to compete with a rival? How should we position ourselves against long-term technology trends? It's high-level, impactful work that allows you to go incredibly deep on a single industry, a single company. The trade-off for the corporate path is clear. The compensation, while still fantastic by any normal standard, is a step down from the stratosphere of an MD in banking or a partner in private equity. The pace is slower. There's more bureaucracy, but what you gain is life. You work a predictable 9 to 6, maybe a 9 to 7. You have your weekends back. You can join a soccer league, have dinner with your family, and plan vacations without the fear of a last-minute deal blowing everything up. For many, after years of sacrificing their personal lives on the altar of finance, this trade-off is more than worth it. So you have the three main branches: stay the course and become a rainmaker, leap to the buy side and become an owner, or cross over to corporate and become a strategist. Each path offers a different definition of success, a different set of challenges, and a different kind of life. The choice isn't about which one is better. It's about understanding who you are and what you truly want. Do you want to be the agent, the owner, or the operator? Answering that question is the single most important decision you will make. But these aren't the only options. The world of finance is far broader, with more specialized, more niche, and in some ways, more interesting paths that begin to open up once you have this core experience under your belt. Let's pull back the curtain on some of these worlds, the specialized domains where finance transforms from a job into a craft, a science, or even an art form. These are the paths for those who find a specific part of the financial ecosystem so fascinating that they want to dedicate their entire career to mastering it. First, let's talk about the world of distressed debt. This isn't for the faint of heart. While private equity is about making good companies great, distressed investing is about finding value in the wreckage of failing companies. Think of yourself as a corporate archaeologist, sifting through the rubble of a business on the brink of bankruptcy. You're not just looking at financial statements, you're reading legal documents, understanding bankruptcy code, and predicting the outcome of complex court battles. Your job is to buy a company's debt, its bonds, its loans, for pennies on the dollar, because the rest of the market believes it's worthless. Then you get to work. Sometimes you help orchestrate a turnaround, providing the capital and expertise to save the company and, by extension, the value of the debt you now own. Other times, you're a vulture investor, a term used, often pejoratively, for those who wait for the company to be liquidated, positioning themselves through the debt they hold to claim the most valuable assets in the bankruptcy settlement. It's a high-stakes, legally intensive game of chess where you're betting against total collapse. The intellectual challenge is immense. You need the financial modeling skills of an investment banker, the legal acumen of a top corporate lawyer, and the negotiating prowess of a diplomat. The payoff? If you're right, turning 10 cents on the dollar into 50, 60, or even 100 cents can generate returns that make traditional investing look pedestrian. Now let's pivot to the complete opposite end of the spectrum: venture capital. If distressed debt is about finding life in death, venture capital is about creating life from nothing. This is the world of funding the future. VCs don't pore over decades of financial history. They invest in ideas, in teams, in visions that exist only on a PowerPoint slide and in the minds of ambitious founders. This isn't about discounted cash flow models. How do you model the future revenue of a company that hasn't written a single line of code yet? You can't. Instead, venture capital is a game of people and markets. Your job is to identify massive, paradigm-shifting trends before anyone else does. It's about meeting hundreds of founders, listening to their pitches, and developing an almost intuitive sense for which ones have the unique combination of genius, grit, and charisma to build the next Google or Amazon. You're not just a source of capital, you're a partner, a mentor, a connector. You sit on their boards, help them hire key executives, and guide them through the treacherous journey from garage startup to global behemoth. The math of VC is brutal. You expect most of your investments to fail, to go to zero. But you're searching for that one company, that one unicorn in your portfolio that returns 100 or even 1,000 times your initial investment, paying for all the failures and then some. It requires optimism, a deep understanding of technology and human nature, and an iron stomach for failure. Then there's the shadow world of quantitative finance. The quants. These are the people who believe human intuition and emotion are bugs, not features, in the system of investing. They are often not finance majors but PhDs in physics, mathematics, and computer science from places like MIT and Caltech. They see the market not as a collection of companies, but as the world's largest data set. Their entire philosophy is to use immense computing power and complex statistical models to find tiny, fleeting inefficiencies in the market, patterns that are invisible to the human eye. They engage in strategies like high-frequency trading, where algorithms execute millions of trades in fractions of a second, aiming to capture a tiny profit on each one. They build sophisticated models to predict market movements based on everything from satellite imagery of oil tankers to the sentiment of Twitter posts. It is a world of pure logic, of backtesting algorithms on decades of data, and of constant innovation. Because as soon as a profitable pattern is discovered and exploited, it tends to disappear as others catch on. It's an endless arms race of intellect and technology, where the person with the slightly faster algorithm or the slightly smarter model wins. The work is intensely cerebral, isolated, and for a certain type of mind, it's the most fascinating puzzle on earth. Finally, we have the gladiatorial arena of activist investing. This is where finance becomes a public spectacle. An activist investor like a Carl Icahn or a Bill Ackman doesn't just buy a stock because they think it's undervalued. They buy a large enough stake in the company to force their way into the boardroom and demand change. They are corporate raiders in modern armor. Their process begins with identifying a company they believe is poorly managed. A company with a lazy board of directors, a bloated cost structure, or a valuable division that could be sold off. Once they've built their position, they go public. They write scathing open letters to the board, they launch media campaigns, they present 300-slide presentations detailing every single mistake the current management team has made. Their goal is to win the hearts and minds of the other shareholders and wage a proxy battle to get their own hand-picked directors elected to the board. If they succeed, they can force the company to fire the CEO, sell assets, buy back stock, or even sell the entire company. It's a high-stakes, high-conflict strategy that requires not just financial acumen, but a mastery of public relations, corporate law, and psychological warfare. It's about having an ironclad thesis and the conviction to fight for it, in the face of immense opposition from entrenched corporate management. Distressed debt, venture capital, quantitative trading, activist investing. These are just a few of the doors that open after your initial years in banking. Each one requires that same foundation of relentless work ethic, attention to detail, and financial modeling prowess you built as an analyst. But they layer on top a deep specialized expertise. They allow you to align your career with your personality. Are you a cynic who loves complexity and legal battles? Distressed debt might be for you. Are you an optimist who loves people and building new things? Look at venture capital. Are you a pure intellectual who trusts numbers more than people? The quant world awaits. Are you a born fighter who loves strategy and public debate? Activism could be your calling. Choosing one of these paths is about more than just maximizing your income. It's about finding the intellectual challenge that will keep you engaged for a 30 or 40-year career. It's about moving from being a generalist to a true specialist, a master of a specific domain within the vast universe of finance. The money in these fields can be astronomical, often far exceeding that of a traditional investment banker or private equity professional. But with that great power and those even greater paychecks comes a different kind of pressure. A pressure that tests not just your intellect but your conviction, your resilience, and your very identity. So let's talk about that identity. Who are you when the models are closed, the pitch decks are sent, and the market goes quiet for the night? Because this is the question that will ultimately determine your success, and more importantly, your fulfillment in this career. The pressure we've been alluding to isn't just about meeting deadlines or getting the valuation right. It's a subtle corrosive force that can, if you let it, reshape you into someone you don't recognize. It's the pressure to equate your self-worth with your bonus. It's the pressure to see people not as colleagues, but as rungs on a ladder. It's the pressure of the golden handcuffs, that insidious state where your lifestyle becomes so dependent on the paycheck that you lose the freedom to walk away, even if the job is crushing your soul. This is the final and perhaps most important crucible of a finance career. It's where the journey turns inward. After you've mastered the technicals, aced the interviews, and survived the analyst years, you're faced with a different kind of deal-making. Negotiating the terms of your own life. What are your non-negotiables? What values will you refuse to compromise, even when a massive deal is on the line? Because those moments will come. You'll be in a room where a decision is being made that sits wrong with you. You'll see a path to a bigger bonus that requires you to cut a corner, to misrepresent a risk, or to step on a colleague. And in that moment, all the Excel skills in the world won't help you. The only thing you'll have is your character. This is why, as you ascend, your focus must shift from simply building a career to building a reputation. Your career is what's on your resume. Your reputation is what people say about you when you're not in the room. It's built in 1,000 tiny moments. How you treat the junior analyst at 2 a.m., whether you give credit where it's due, whether you have the courage to speak up and say, "I think we're missing something here," even when it's not the popular opinion. In the small, incestuous world of high finance, your reputation is your most valuable asset. It's the currency that buys you trust, that opens doors to new opportunities, and that ultimately allows you to build a career that lasts decades, not just a few burnout-fueled years. So, how do you protect this asset? You define your why, not the why you put in your cover letter. "I'm passionate about capital markets," but your real fundamental reason for being in this industry. Is it to build something? To fund the next great technological leap? To provide for your family in a way you never thought possible? To master a complex and intellectually stimulating craft? Your why has to be something more profound than the money or the prestige, because both of those things are fleeting. There will always be someone with a bigger bonus or a more impressive title. But your purpose, that's yours alone. It's the anchor that holds you steady when the storms of market volatility, office politics, and sheer exhaustion try to pull you off course. Write it down. Revisit it. Let it be the guiding principle for every major decision you make. And as you progress, you must become a lifelong student. The analyst who memorized every valuation formula will be replaced by AI. The associate who knew every LBO model inside and out will find those models becoming automated. The skills that get you in the door are not the skills that will keep you at the top. Your value will shift from doing the work to thinking about the work. It will be about seeing the bigger picture, understanding geopolitical shifts, anticipating technological disruption, and connecting disparate ideas to form a unique investment thesis. It will be about your judgment, your network, and your ability to persuade. This requires a relentless curiosity. Read everything. History, psychology, technology, biographies. The best investors and bankers are not just finance experts. They are students of the human condition, because at the end of the day, markets are driven by two powerful emotions, fear and greed. Understanding the nuances of that is the ultimate competitive advantage. Furthermore, you need to understand that this is a marathon, not a sprint. The industry glorifies the sprint, the 100-hour weeks, the all-nighters, the sleep is for the weak mentality. And while those periods are sometimes unavoidable, a sustainable career is built on a different framework. It's built on protecting your physical and mental health. It's built on cultivating relationships outside of work, with family, with friends who don't know what EBITDA stands for. These are the people who will keep you grounded, who will remind you of the world outside the Bloomberg terminal, and who will be there for you when a deal falls apart or a promotion doesn't come through. Don't sacrifice your health or your relationships on the altar of your career. The graveyard of Wall Street is filled with people who made that trade and regretted it. The true titans of the industry, the ones who last, learn to integrate their work into a rich and fulfilling life, not the other way around. And finally, let's talk about the ultimate payoff. If you navigate all of this, the technicals, the networking, the politics, the personal challenges, what do you get? Yes, you get financial freedom, and that is a powerful life-altering tool. It's the ability to take care of your loved ones, to travel, to pursue hobbies, to never have to worry about a medical bill. But the true lasting reward is something deeper. It is the profound satisfaction of operating at the highest level of your craft. It is the privilege of sitting in the room where decisions are made that shape the future of industries. You're not just reading the headlines. You are, in a small way, helping to write them. You're providing the capital that allows a biotech company to cure a disease. You're advising a founder on the sale of the company they poured their life into. You're helping to structure the energy infrastructure that will power a city. This is the real work. It's complex, it's messy, and it's incredibly high stakes. But it's also a chance to have a tangible impact on the world, to be a catalyst for growth and innovation. The journey we've outlined across this series is brutally difficult. It will demand more from you than you can possibly imagine. It will test your limits, it will force you to confront your weaknesses, and it will require a level of dedication that few possess. But the path is there. It has been walked by many before you. It is not a path of privilege, but a path of preparation. It's a path of relentless learning, of building genuine relationships, of developing unshakable resilience, and above all, of knowing who you are and what you stand for. So, as we conclude, the question isn't just, do you want a career in finance? The real question is, are you willing to become the person who can succeed in it? Are you willing to do the work when no one is watching? Are you ready to face rejection and treat it as data? Are you prepared to build a reputation for integrity that is as sterling as your financial models? If the answer is yes, then everything we've talked about is not a barrier but a blueprint. The door is not closed. It's just heavy. Now go and start pushing.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.